Hello students, this is the recording for Chapter 6, the last lecture, Lecture 3. In Chapter 6, we have been using Pick n Pay's financial statements for the year ended February 2019, and these are available on ClickUp under the subject content for Chapter 5. So we, in the last lecture, had calculated the net profit margin for 2019. We were looking at what the net profit was before tax, this number of 2199, that's 2 billion, and we compared it to the turnover of 88 billion, and the profit is 2.49% of the turnover. We got this information from page 26 of Pick n Pay's financial statement. So for 2018, if I take the profit of 1,768,100,000 Rand and compare it to 2018's turnover, the percentage is 2.2%, which is marginally less than it was the previous year. And that information is also from page 26. It's just the 2018 information that we use. So which of the following statements is not true? Did the net profit margin for Pick n Pay decrease from 2018 to 2019? That statement is not true because, in fact, item B is true. The net profit margin increased from 2018 to 2019. Net profit margin measures the entity's success with respect to its earnings on sales and will always be lower than the gross profit margin because gross profit is just sales minus cost of sales, and then we subtract all our other expenses to get to net profit. Both net profit and gross profit margin are calculated based on sales. So if the net profit is lower than the gross profit, it means this margin will always be lower as well because they're calculated on the same number, sales for the year. So last time we also calculated the return on investment, and we took the total assets, that's on page 27 of the financial statements. The total assets were 19 billion and the total comprehensive income was 1,365,000,000. And that meant that the return on our assets was 6.88%. So the return on investment for 2018, if we calculate that, we take this year, the 2018 comprehensive income, and we divide it by the 2018 assets, and we get a percentage of 6.58%, which is marginally less than it was in the previous year. So which of the following statements is not true? The return on investment measures the effectiveness of the entity's management of assets. That statement is true. That's what return on investment does because it compares profits to assets and it tells us how well management has been able to use their assets to generate profits. So the higher the return on investment, the better. B says Pick n Pay produced a higher return on investment in 2019 compared to 2018, and that's also true. It was marginally higher in 2019. C says if Pick n Pay's total assets were higher in 2019, their return on investment would be higher. D says if Pick n Pay's total assets were lower in 2019, their return on investment would be higher. So C and D cannot both be true. The one that is not correct is C. So what we are saying is that if we think about our calculation and we keep our return, or our profit rather, let's say this is our profit that we're using, our total comprehensive income at the top, and at the bottom we have our assets. So now if that asset number becomes higher, it means we're then calculating profit on a bigger number, and that means that in fact my return is going to be a smaller percentage because we're using profits on a bigger number. Then if I look at D, and I'm now saying that I've still got the same profit, same numerator, but now my denominator is actually going to go down. So it means I've got less assets. So now if I compare the numerator to the denominator, which is now lower, and I've got the same profits but on less assets, it means I'm going to be having a better return, a higher return on my investment. Return on equity, we also calculated what the profit was for the year and we compared that. That was our total comprehensive income. We used this in our return on investment, return on total assets ratio. And here we're now comparing it to the equity at the end of the year, which was 4.3 billion. And this ratio was 31.62% in 2019. For 2018, the same ratio. We take the total comprehensive income for 2018, we compare it to the equity for 2018, and the return was slightly lower, 31.06%. So now, which of the following statements is not true? The first says, if Pick n Pay's total equity was higher in 2019, then the return on equity would be higher. And the next one says, if Pick n Pay's total equity was lower in 2019, then their return on equity would be higher. So they cannot both be true. So which one is incorrect? A is incorrect because if equity is higher, that means my denominator in my equation is higher. Then it means that my return on equity is actually going to be lower because I'm going to have the same profits, but I'm now calculating it on a higher amount. So that means I'm going to have a lower return on equity. So this is incorrect. If Pick n Pay's total equity is lower, that means my denominator is smaller, but my profit, my numerator stays the same, then I'm going to have a higher return on equity. So that statement is correct. C and D are also correct. Pick n Pay's owners were better off in 2019 because they had a slightly higher return on equity than in 2018. A higher return on equity means that the owners are better off. They're getting a better return on the money that they've invested in the business. The next ratio, the last profitability ratio that we're going to look at, is the price-earnings ratio. This price-earnings ratio uses the market price for ordinary shares. This means that this ratio can only be used when we have a company, because companies have shares, and when we have a company that has a market price. So market price refers to the price at which you can buy shares in this company on the Johannesburg Securities Exchange. So it would have to be a listed company, a company where that shares are listed on the JSE, and that means there will be market prices available at which these shares are being bought and sold publicly. So we need the market price per share, and then we're going to divide that by the earnings per share. That information comes from the financial statements, and you will find the earnings per share on page 26 of Pick n Pay's financial statements. So Pick n Pay's earnings per share has been calculated at the bottom of the page, and if I give you a company's financial statements, you will see these numbers at the bottom of the page. Here's the earnings per share, and the one we are going to use is the basic earnings per share over here, 347.17 cents, which is the same as R3.47. I just want to show you how that gets calculated. You will not be expected to do this calculation for a company, but if you go to page 26, you will find that the profit that's available for shareholders before other comprehensive income is 1,649,500,000, and then the weighted average number of ordinary shares that were in issue during the year were 475,126,900 shares. So if I take the profit, divide by the number of shares, it gives me R3.47. So in other words, each share has a profit attributable to it of 347.17 cents. Now let's look at the market price. I got this off the internet on the 3rd of September. The market price, this was at 11 in the morning, was 5747. In fact, it was at 10:38. The price was 5747. That's 5747 cents. So in fact, if you want to express this as rands, it's 57 Rand and 47 cents. But share prices are usually always expressed in cents. That's 5,747 cents. So now in my formula, I'm going to take that market price of 5,747 and I'm going to divide it by the earnings per share that we saw on the bottom of the statement of comprehensive income. That's going to give me an amount of 16.55, which means that the market price is 16.55 times higher than the earnings per share. So the earnings per share were 347 cents and market participants are willing to pay 16.5 times that amount for one share in Pick n Pay. If this ratio is low, it means that the market price will then start becoming similar to the earnings per share. So if this top number, for example, was 347 cents, it means that the market price and the earnings per share would be equal, and the ratio would then be equal to 1. That would indicate very little investor confidence in the Pick n Pay shares. But when this ratio starts getting bigger, like it is here for Pick n Pay, it means that the market has confidence that this company is going to make more earnings in the future and that the company is going to grow. So that means they see potential in the company when they're willing to pay 16.5 times more than the earnings per share for the last financial year. They're willing to pay more per share when they buy the share. The last set of ratios we need to look at is the solvency ratios. We're going to use Pick n Pay, and I'm also going to use example 6.2 in your workbook. Please have a look at this example and go through it in your own time. So the debt to equity ratio, this is telling us how much are liabilities compared to equity. So in the case of Pick n Pay, I can add the non-current and current liabilities together and I get 15,537.5 million. And I'm now going to compare it to my equity. So in my ratio, I take 15 billion and I divide it by 4 billion, and the answer is 3.6, which means for every 1 rand of equity, Pick n Pay is financed by 3.60 rand externally. Okay, so Pick n Pay actually has quite a high level of debt. For every 1 rand that the shareholders have put in, external providers of finance have put in 3.60 rand. So the higher this amount becomes, the higher this 3.60 rand becomes, or 3.6 in this case, it's 3.60 rand as compared to 1 rand. The higher this becomes means that the company is then more and more being financed externally. If this number was low, then your liabilities and shareholders' equity could be equal. So if they were equal, it means this answer would be 1, and it would mean that liabilities and shareholders' equity are the same. So that means for every 1 rand that the owners put in, there's 1 rand of external finance. So as this number goes up, it means the proportion of external finance is increasing. And that can be seen as being risky because it means you now have amounts owing to external providers and you've got to pay interest on that amount. The benefit of having external finance is that if you can borrow money at a cheaper rate than you can invest, then it makes an opportunity for profits in the future. So in this case, liabilities are 3.6 times the amount of equity. The next ratio is the debt to asset ratio. So we already saw the liabilities were 15 billion and the assets are 19,854 million. So if I take 15 billion and I divide it by 19 billion, it gives me a ratio of 0.78, which means that for every 1 rand of assets, 7.8 is financed externally. If this ratio goes over 1, it's not a good indicator because then it means your liabilities over here start exceeding your assets. So remember, our assets are what you use to pay your liabilities. So if your liabilities are more than your assets, you're actually going to be insolvent. So when this ratio starts being bigger than 1, it means the business is in serious trouble because they do not have enough assets to pay their liabilities and they are insolvent. The last ratio is interest coverage. Here we're going to take earnings before interest and tax, and we're going to divide it by the interest expense. So the earnings before interest and tax I'm going to take from the statement of comprehensive income. It's this 2 billion, and then the interest is 349 million. So if you take 2 billion and divide by 349 million, you get 6.23, which means that during the current year, the profits of Pick n Pay were 6.23 times more than the interest they had to pay. So they had more than enough profits to be able to pay the interest. This is now the final ratio that we had to do, the solvency ratio. So for this ratio, we're going to take example 4.2. I'm not using Pick n Pay. For this ratio, we're going to use profit after tax but before depreciation. So we're going to exclude non-cash expenses. So on the top line, we are basically talking about cash profits, if you like, and in the bottom line, we're talking about total liabilities. So in this business, cash profits are 95% of total liabilities. So that means that 95% of the liabilities could be paid with the profits of 2019. For 2018, the ratio was 59%, which was lower. The ratio actually improved. The ability of the entity to cover its liabilities with profits improved from 2018 to 2019. A ratio of 20% is normally considered acceptable. Anything less than 20% means that you do not normally have sufficient profits to cover your debts, the amount you're going to have to repay on liabilities. So these are the outcomes that you need to meet for Chapter 6. The first two are explain the purpose and discuss the advantages and disadvantages. That information is on the first 2 pages of your workbook. And then to talk about the different types of ratios. So liquidity ratios are where we're comparing current assets to current liabilities, and we're measuring our ability to pay our debts, our current liabilities in the short term, amounts that we have to pay within the next year. Do we have enough current assets to cover that? That's what we talk about with liquidity. Then we did the profitability ratios. Those were the gross profit percentage, net profit margin, return on equity, return on assets. We also did the price earnings ratio. Those are all telling us about how profitable the company is. The activity ratios related to inventory, turnover rates and the number of days inventory on hand, as well as the debtors collection period and the creditors payment period. So those are our current assets and liabilities, how those change, how long it takes for us to pay or receive money, and it gives us information about the activity of, as I said, current assets and current liabilities. Then the last set of ratios talk about the solvency. Solvency is our ability to pay our debts and our total debts that are owing. And basically a company is insolvent if its liabilities exceed its assets. But the 4 ratios that we've just covered all relate to liabilities, paying liabilities, and paying our interest on our liabilities. Then to end off, there are 6 questions in the question book which you should now please practice for this chapter. Thank you. See you on Monday.